Hi all, welcome again to our Borrowing from LISC webinar. Before we begin the presentation, we wanted to share a couple of housekeeping rules. Everyone should be muted upon entry. If you have any questions, feel free to send them through the WebEx Q&A on the right-hand side of your screen. We will leave questions until the end of the presentation. My name is Anna Sukowski, and I am a Program Manager in LISC's Lending Department. I'll be moderating today's webinar, and I'm joined by Connie Max, our Senior Vice President of Lending, Melanie Nair, our Vice President and Chief Credit Officer, Shara Hayes, a Senior Program Officer out of Virginia LISC. To start things off, we have a quick poll for our listeners. So the first question is around if you are currently a partner with LISC and have a local LISC contact in the field, and the second is, have you ever borrowed from LISC before? We'll wait a couple of minutes for people to be able to submit their responses. All right, so everyone should be able to see the results, I believe. It looks like we have a wide range of listeners with various experiences with LISC. So we hope this presentation will help answer all of your questions on everything you always wanted to know about LISC lending. So next, I'm going to run through the agenda very quickly. So we're going to go through a brief intro to LISC and how our departments function together, go through some examples of our loan products and project categories, walk through our application checklist and due diligence expectations, then outline our loan monitoring and asset management operations, and then summarize with some questions and comments at the end. So I'm going to now hand it over to Connie Max, who's going to run through our intro to LISC.
Great. Thanks, Anna. Thanks, everyone, for calling in or logging in today. We appreciate your interest. It looks like there's a good mix and some folks that don't really know LISC well. So LISC stands for Local Initiative Support Corporation, which doesn't sound very much like a lending institution, but we are, in fact, a community development finance institution. It's a tough elevator speech to give when you're trying to describe community development finance institution, but fair to say we're a niche lender. We are a place-based lender. We are committed to serving underserved communities. We provide loan products that address the needs that fall into areas that are low and moderate income. They suffer from persistent poverty. They're in food deserts or other underserved markets that traditional financing doesn't address. We're not a bank. We don't take savings or checking deposits, and we do not have ATMs in our offices. So we're really meant to be part of the community and to address the needs that arise in the community. We do provide loans, which is today's topic, how to borrow from LISC. On slide that's up currently, you can see LISC has been around a long time, almost 40 years, and through our affiliates, New Markets Tax Credit, affiliate New Markets Support Corporation, our affiliate National Equity Fund that provides syndication for low-income housing tax credit, we've made investments of more than $18 billion directly, and that's leveraged or has supported more than $56 billion in investments nationally over the last 40 years. We've done hundreds of thousands of homes. We've done millions of square feet of commercial, retail, and community space. We have a strong balance sheet. After 40 years, we've been able to build up net assets. And a couple of years ago, kind of answering that conversation about how do you describe LISC and a community development finance institution to folks who don't know our industry, we decided to seek an S&P rating in 2016. In 2017, we were the first CDFI to issue a general obligation bond with an S&P rating, and our current rating is AA stable, which is an investment grade rating, and it's something that institutional investors, retirement funds, high net worth individuals all understand. So it helps LISC gain, fund more money to serve our communities. So we go to the next slide. So our impact, outside of the lending, we also have departments within LISC that focus on financial opportunity centers that provide technical assistance and training to help people find employment. We have over 80 financial opportunity centers to date, and in the last 5 years, they've served nearly 80,000 individuals. We also provide funding for fields and recreational spaces. We've done hundreds of those fields. We have a current commitment to do 26 soccer fields ahead of the World Cup in 2026, and so that's an initiative that we're focused on. We work to provide healthy food options. In addition to our lending, we have other projects that serve thousands of families to provide healthy food. We have hundreds of other projects that address arts and community space and creativity to help serve the communities where we work. In slide 7, sadly, I want to call this everywhere but Nebraska. You can see from the slide where LISC is and who we serve. We have boots on the ground, local offices in 35 locations, and our rural work goes through partners. So we have more than 2,000 partners in 44 states to address the needs of our rural markets, our areas of persistent poverty. And as I noted, we have 3 national affiliates. I mentioned the first 2. The third, immito, is an SBA lender and hit the ground running a matter of weeks ago. So currently we support our communities with New Markets tax credits, low-income housing tax credits, and LISC lending serves all of the communities you see on that slide. So what do we offer? I think we've touched on the project types, but the loans that we offer that tend to fall outside traditional financing is early phase, pre-development, acquisition, construction, mini-perm, permanent, bridge, lines of credit that will address long lead times and receivable periods, and working capital needs for pre-development that are ongoing with an experienced developer. If you're following along, the top right corner has our LISC.org /lending. That will bring you to our product summary sheets and additional information If you want more detail on one of these particular products, you can find it there. At this point, I'll pass the presentation over to Molly Nair, who is our Chief Credit Officer and Vice President for Lending, and she'll get into a little bit more detail on how we get to yes in lending.
Thanks, Connie. So Connie touched a little bit on some of the products that we offer. This is a more detailed explanation of the terms of the different products we offer. So as Connie mentioned, we provide a range of financing ranging from pre-development to permanent financing, as well as bridge loans and working capital lines of credit. These products have typically been used across all of our project types that include affordable housing, for community facilities, charter school financing, and commercial development. I'd like to call out a couple of points on this slide. One is that our loans can go up to $8 million. The pre-development loans are a little bit smaller in range, but we do have the authority to go up to $8 million in financing. The loan terms range based on the type of product that we're offering. But on the permanent side, we can go up to 18 years. Our amortization can go higher than that, so we could amortize on a 20 to 25 year basis. The interest rate is based on a risk-based pricing model. It ranges between 5.75% and 8%. I will talk a little bit about that on the next slide. And a couple of other points. Most of our loans are secured, real estate secured or other forms of acceptable collateral. That might include letters of credit, that they might include earned developer fees, that's a receivable. We bridge government contracts at times, so that's why you see the bridge loans. We also bridge historic tax credit equity, and that's also an acceptable form of collateral. So, but most of our loans are secured by real estate, either in first position or second position. The other thing to point out on this slide is that if you're a for-profit developer, one of our requirements is that these loans for profit developers are guaranteed personally. That is one of our underwriting requirements. If you can go to the next slide. So to talk a little bit about how we price our loans. So the pricing of our loans is based on the cost of capital to LISC. So LISC borrows money from banks and other financial institutions. So there's a cost of capital to LISC that is based on a certain term, and then the risk associated with making a loan. The risk factors that go into play include the type of product and the type of project. So, for instance, a pre-development loan tends to be more risky than, say, an acquisition or a construction loan because it's more early stage financing. The other factors that impact the risk associated with a loan include the collateral, the repayment source, the experience of the project team and the development team, and the financial health of the borrower and the sponsor. So basically, the higher the risk, once we risk rate these loans, the pricing is determined based on that and the term of the loan that we're offering. Go to the next slide. So, as I mentioned on the last slide, the pricing is determined based on the cost of capital to LISC. So where does LISC get its capital? Our capital comes from a variety of sources. I would say majority of our capital sources include national and regional CRA banks. So that's the one on the extreme right. We have roughly about $200 million that we've borrowed from these banks in short-term lines of credit that are available for us to lend across the different products that you just saw and in either certain markets or nationally. In 2017, we issued a bond, a general obligation bond, which allowed us to raise $100 million from institutional investors. So that is another source of capital that gives us 5-year tranches of money, 5 to 10 year, and then up to 20-year tranche of money that we can use to lend. We also have long-term capital from the CDFI fund through the bond guarantee program, and that's $50 million. So that sort of falls under the bucket of government and public agencies. And then we also have about monies from insurance companies, such as State Farm and others that also allow us to lend in certain markets for certain products. Finally, we also get PRIs, program-related investments from foundations and other philanthropic institutions that have sometimes lower cost capital, so we're able to use that for certain programmatic lending or place-based lending. Even though we have a risk-based pricing model and our pricing is fixed, we do have subsidized sources of capital for certain programmatic initiatives. So as an example, LISC has received awards of capital magnet dollars from the CDFI fund, which allow us to provide lower cost financing for very affordable housing development. So housing development that serves families in the 50% AMI range. Another example is the Healthy Foods Financing Initiative capital that we received also from the CDFI fund, which allows us to blend down the interest rates and credit-enhanced loans for grocery stores and food-related businesses across our markets. So we do have the flexibility to reduce the interest rates based on whether your project fits a certain criteria. Okay. So earlier this year, we launched a subset of products really targeting economic development and small business development. It is really tied to a strategic plan and programmatic growth in the economic development space. These products that you see on this sheet are really to complement what our affiliate Immito is offering. Immito, which I will talk about in the next slide, is offering an SBA loan product, which is partially guaranteed by the SBA. These products are trying to address the gap that the SBA space cannot fill. So these products range in size from roughly $10,000 to about $5 million. The very small loans are a product that we offer through a partnership with Kiva, so that's between 0 and 10,000. And then we have a few working capital, leasehold improvement type of loans. Those are the accelerated business loans, permanent working capital, and the leasehold improvement and furniture, fixture, and equipment loans. Those are really for small businesses that are looking to grow, either by expanding into a new space or taking on new contracts. So these products are geared to help those businesses access capital. And then the last two products, which are makerspace loans and commercial real estate loans, these are loans that LISC has been making, so it's not a new space for us. But we are sort of we're seeing more and more of these in many of our markets, and so this is sort of trying to define these products a little bit more. The two things I'll call out here is the interest rate here is a little bit higher than the rates on the previous slide, and that is really to take into account the risk associated with making loans to small businesses. Second is you will see that there is a line which says credit enhancement. That's really LISC's way of addressing the risk associated with making these loans and offsetting that risk. So these products are not guaranteed by the SBA. However, our local offices have either gone out and raised grant monies to offset the risk of making these loans, or there are guarantees from cities or foundations that are interested in working in this space that help us make these loans without taking on too much of the risk. So as I mentioned, we recently established an affiliate entity, immito, that provides SBA 7A loans. This is a standard SBA product. It is geared to small businesses across the country with loan sizes ranging from $250,000 to $5 million, and they are for real estate development, leasehold improvements, equipment, permanent working capital. The terms range between 10 to 25 years, and the pricing is variable. And our affiliate has just opened for business, so we're very excited that they're able to offer a product that complements the other suite of products that LISC is able to offer. Okay. So I'm going to just give you a few examples of projects that we finance, and just to tell you that even though we have these products and we have our credit guidelines, and give you examples of what makes us unique and different from a typical bank that you might work with. So the first project is Sarah's Circle. Sarah's Circle is a nonprofit that serves homeless women and senior citizens. This particular project was a preservation of 34 units of affordable housing, as well as the creation of an additional 15 units, and it preserves the affordability for an additional 40 years. So that was a really nice aspect of this financing that we could be involved in. We provided the very early stage financing, so that was $550,000 in pre-development financing before the project was able to acquire the property, and only a third of the repayment sources were committed at the time that we made the loan. So it's really very early stage financing. We were able to get comfortable with the loan because we were able to secure it with a lien on another property. So that's an example of a pre-development early stage financing that LISC provided. So the next example is an example of an acquisition loan that LISC made to SRO Housing Corporation in California. SRO is also a nonprofit organization serving homeless and low-income individuals. The project itself is a new construction of approximately 120 affordable units, and LISC provided $5.4 million in acquisition financing alongside another CDFI partner, the Corporation for Supportive Housing. We were able to make a loan that exceeded our loan-to-value guidelines, and the reason we got comfortable with that was twofold. One was we had the capital magnet dollars, which really helped us offset the loan-to-value risk. There was also money from the Los Angeles County that served as credit enhancement for the overall financing of the project. And then thirdly, we were able to put in certain disbursement milestones such that our exposure was always, as far as the loan-to-value was concerned, was always contained until all of the next stage financing was secured. So we were able to get creative with the financing structure to be able to support this project. So Paramount Square is a project in Cincinnati, Ohio, where we've worked with a long-standing partner of LISC, the Model Group. We've provided over 16 loans to them, and the Model Group is involved in historic preservation and adaptive reuse of spaces. This particular project was the adaptive reuse of a historic theater into housing and commercial space. And the project was financed using New Market Tax credits. LISC was able to provide a loan associated with the New Market Tax credit financing. Those loans are called leverage loans, and typically they're not directly secured by real estate. And it's a sort of a niche product that LISC and some of the other CDFIs are able to offer. We were also able to provide them a roughly $500,000 or $600,000 bridge loan, which was an unsecured portion of the financing. So that's an example of using New Market Tax credits. Next slide. Finally, this was a project in Chicago that was developed by the Chicago Neighborhood Initiative. It's the construction of a 75,000 square foot grocery store in the Bronzeville suburb of Chicago. This is a good example of a project where LISC was able to use its Healthy Food Financing Initiative subsidy to provide a low interest rate construction loan for this project. so that we can reduce the interest rate during the term of construction. Again, in this loan, we partnered with IFF and a number of other financing entities, and really were able to support a project that would bring healthy food to a neighborhood that was classified as a food desert. Okay, so I'm going to hand it over to my colleague Shara, who's in Virginia, and he can talk a little bit more about how you work with your local office to be able to get a loan from LISC.
Thank you, Melanie, and good afternoon, everyone. Thank you all for participating in the webinar to learn a little bit more about LISC lending and how we get to yes on the project. Again, my name is Shara Hayes. I'm the Senior Program Manager for Lending in the Virginia LISC office, and we're located in Richmond, Virginia. But LISC has about 30, a little over 30 separate program offices throughout the country, and each local office may operate a little differently when it comes to programming and service delivery. However, there are some characteristics and consistencies within all of our footprint that helps the project get from project concept to reality. Three of the core components are project purpose, the relationship, and the flow of LISC dollars into and out of a project, meaning the funding that goes into the project and then LISC getting repaid once the project is complete. As it relates to project and purpose, LISC, and you may have heard, you'll probably hear a lot of the same sort of terms repeated throughout the presentation. LISC is place-based and mission-focused. We are more concerned about the quality of the transaction more so than the quantity of transactions closed. Things we look for include if your project is going to benefit or be targeted to a low-income person or a low-income community. We want to know if there are going to be jobs created from the project or if it's going to address affordable housing issues in your community, access to affordable health care, healthy foods, community spaces, access to education, and so on, primarily charitable purposes. As it relates to the relationship, just like all businesses and organizations, good relationships and trust are key to sustainability. We work hard at maintaining these strong relationships with our current partners, and at the same time, part of the reason for this webinar is so that we can establish new relationships with new partners that are interested in advancing economic mobility and equity in the communities and neighborhoods where we provide services. The relationships may often include technical assistance or capacity building strategies for our nonprofit CDC partners, mainly to help them get to a scale of development so that we can eventually help more people with the services we provide. Trusting relationships are even more integral when it comes to dealing with lending and money. So real estate and a level of trust must exist. The project, the purpose, and the relationship are all very important pieces to our core components. However, when it comes to when you drill it down to its simplest form, there is a monetary transaction that has to make sense financially, and that's where we look at the money in and money out piece. We will have to understand, how LISC dollars will flow into the project and identify the sources for repayment of the LISC funds, and if there are any other funding sources that may be leveraged within the financing structure. We can go to the next slide, please. Of course, the objective is getting to yes or an approval for your loan request. Understanding the charitable purpose is important as it relates to our mission. serving a charitable purpose is key to approving, getting your loan approved. What we look for is the project meeting our core mission, and is it in our footprint? Again, like I say, you'll hear a lot of the similar phrases here, like low-income communities, employment opportunities, things like that. We look for those things as part of our charitable mission for a project. Our financing is a loan, and it's structured that way, and the project and the developer both will have to be underwritten for risk. Collateral will be also required in most cases. This collateral and security usually involves real estate or other assets. The loans are recourse to the borrower and to the grantor. We also look for momentum, local support for your project. Does the project make sense for the neighborhood? Has the community at large been engaged in the process? And is there capacity, of the borrower? Does the borrower have the capacity and experience to complete the project? Also, we need to be comfortable that the borrower, has done the due diligence for the project. If not, additional technical assistance or capacity building may be required before getting to yes. One solution in this case could be partnering with an experienced developer in the type of project that you're seeking financing for. Next slide, please. So this slide has a snapshot of our application checklist. As you're putting your project together, you will be creating many of these items, and many of which you should already have, like your financials or audits. Other items may be required for closing a loan, and may be funded with the loan proceeds, like the due diligence reports and the appraisal, for an example. The items on the list they're needed to help us determine the project, to underwrite the project and evaluate the borrower's and guarantor's financial strength and capability of completing the project. Next slide, please. So in this slide, I've highlighted, have highlighted here the new Clay House apartments. LISC provided a $1.6 million acquisition loan for the project. The acquisition loan allowed the developer to exercise an option they had on the property at the end of a long-term lease. I wanted to feature this project because it provides good examples of the three LISC core components that were on my second slide. One was purpose. The purpose of this particular transaction was to provide affordable and special needs housing in a LISC supported neighborhood. Number two, the relationship piece. This action was submitted by one of our longtime partners, Virginia Supportive Housing. They've been a longtime partner with Virginia LISC, and we've provided probably over 30 transactions to this organization over the last 15 to 20 years. And then the underwriting piece, the money in and money out, the acquisition loan positioned Virginia Supportive Housing to recapitalize the project using low-income housing tax credit and construction financing. The construction financing was used to repay the LISC acquisition loan. And the end result of this project will be 80 high-quality, affordable rental housing units serving low-income special needs residents in a Virginia LISC targeted investment neighborhood. And now I wanted to pass it on to our next presenter.
Thanks, Shara. So Connie Max, I head up the lending. I'm back again. As we've touched on several times, LISC is place-based. We really want to know that we've got boots on the ground, that there's somebody locally, local initiatives who are supporting the projects that come through. There's, connections in the local government and the community. As Shira outlined, that there's been vetting locally with the community where the project's going to happen, that there's buy-in, that there's commitment. So we are locally based, but we have a national infrastructure to manage the loan products. And so Shira identified the new clay project, and he works closely with the team here in New York City to check in and see, hey, does this work? What kind of special pools of money might we have to support the project? And how can we get the best rate and the best product to my borrower, my client, in my local office? So there's a relationship that, we're constantly in touch. And the national function is very predictive because we have so many offices, we have so many partners. We want to, be able to predict when credit committee is and when approval processes might happen. So we have a weekly review and intake process. So Shira would do kind of a little short summary from that application, kind of a 2-pager of the request and what it is. That gets reviewed once a week. We then get feedback to the local office, green lighting or asking for more information or suggesting a phone call to kind of talk through some identified risks or concerns. Credit committees every week. We have a national credit committee. They have the approval authority of up to $5 million. If a loan request comes in above $5 million, as Malini noted, we can go up to $8 million, but when loans get larger, our board likes to take a look and have sign-off. So up to $5 million to $8 million is a subset of our board that reviews and approves those loans, and any loan above $8 million is reviewed by our credit committee. The subset of the board is meets at least quarterly and sometimes ad hoc meetings, maybe up to 8 times a year. And I'm just noting it's actually $7 million that the credit committee has approval authority to, and anything above 7 is goes to the board. We also work closely with legal and finance to get loans funded and closed. So once a program officer, if Shira brings a loan through, it gets a green light on intake on Monday, and then he brings it through in the next couple of weeks. It gets approved. We have loan closers, in-house attorneys, legal, and finance who all work together to gather the documents and put together loan documents to fund and disperse loans. We have in-house oversight for disbursements on construction loans. We have loan closers to help gather the documents and work with the legal department to make sure things move through as smoothly as possible. And then finally, we've noted that we are not a bank, but we are a financial institution. We once your loan is funded, we still have the need to report out on its performance and if it's paid on time, if there are any changes or needs to amend. So we have an in-house asset management team. Again, they work closely with our local office. We try to, keep our reporting to, as needed. Larger loans are seen more frequently. Smaller loans tend to be once a year. You will, if you get your loan and it funds, we will be reaching out to get information so that when we get audited by S&P or one of our funders audits, some of the government funds required particular audits, we have everything in order, and we can, keep our S&P AA rating that we are maintaining our loans and managing our balance sheet, and we'll be able to repay the folks that lend us money to get to you all. We can go to the next slide. I think both Malini and Shira touched on our core components of LISC investing, how we get to yes, and the screening of the charitable purpose and the impact and strategic importance in the neighborhood is really done at the local level. Occasionally we'll ask for more details about approvals and support, but once it gets to the National Credit Committee, it's really trying to understand that we're structuring the deal the best way, that the organization asking for the loan has capacity. We talked about financial strength. Do they have enough liquidity? Do they have enough cash? If there's a delay in the project and they need to put more money in to keep the project going, if there's a surprise, do they have access to financial resources to make sure we get, a building built, a school built, a housing project completed, and do they have a history of repaying LISC or other lenders? So we look at financial strength, organizational capacity, how many projects is this borrower working on at one time? Do they have the bandwidth to really get this done in the reasonable time frame? And then once we look at all of that, we'll take a look at if there's a collateral available, real estate, leasehold interest, earned developer fees, and then decide, what the loan term should be. Just Sharon and the folks in the field, are experts at this. They come in with a very reasonable structure. They will have, dug in and taken a look at the cash flow projections to make sure it's an appropriate amortization schedule and that someone's not asking for a $3 million loan to buy something that's a $500,000 property, and that they're not going to be over leveraged or unable to repay us. And then, repayment. What happens if the market, takes a downturn and rents go down, or is there a subsidy supporting this? What happens if costs increase, if interest rates go up during the term of our loan, and someone's relying on construction financing that's at an adjustable rate? Is there a clear plan B if the borrower doesn't get some subsidy that they're planning to get? What happens if they don't get their tax credits, or if a CDBG, a grant from the city, doesn't come through? Is there a plan B? Is there a way to still create value and some sort of positive impact in the community? Do they do a couple less apartments? Does the sole commercial project turn to mixed use and they put some residential units above a small commercial project? Have they thought through what the plan B will be? And so we'll have those conversations. The local office will have gotten some of that feedback during the intake. They get some of those questions ahead of credit committee. And so typically in a credit committee, we'll finalize some details, we'll ask for some follow-up, and we'll get to yes. The next slide is just kind of the timeline for approval and closing, how to speed up your process. We get this question a lot, and I think as much from some of our local offices who are new as to the borrowers. I think that the key in all of this is having your information complete and available when you come in to ask for your loan. If you haven't finished your audit for your audited financials, and you want to come in and ask for a loan, we really do want to see your audits. If it's in September and you haven't gotten an audit from the prior year, that's going to slow you down. It's going to be a request before we close a loan. If you are planning to take on a site that has environmental issues? Have you gotten your third-party report, your phase 1 from an environmental engineer that says, you know, how extensive it is, how much money you might need to complete it? Have you assembled the right team? Do you have someone that understands the project and can address some of the issues that might come up? Do you have an architect? Do you have someone that manages the budgets and spreadsheets? If you're applying for tax credits, have you found a consultant to help you do that if you've not done that before? So kind of planning ahead and laying out the information that you know we're going to ask for and gathering as much of it in advance as you can will speed up the process. Hiring an attorney who has done this sort of work before. If you have somebody on your board who's going to help you, you know, please check that they're a transactional attorney and not, you know, in litigation or some other area that will be a learning curve to help you get your loan closed. So those are kind of big picture ideas or you know, strategies to get to yes and get closed as quickly as possible. Your local program officers are your best support in you know, getting a loan from LISC, getting it closed, and then you know, making it a smooth transition. So you know, we really encourage you to start in your local community, and then you know, we all work closely together to get, you know, projects developed in your neighborhoods. So I think we talked a bit about asset management, and again, it's just gathering reports that'll be clear in your loan agreement. So, you know, audited financials. If you're in a particular subsidized source of funding, we'll let you know that before the loan closes, that we'll need number of children in the seats if it's a charter school. We'll need, you know, number of individuals served if we're providing a small business loan that's supporting a particular product and category. But those requests will be clear before the loan is closed, and you will make sure you're comfortable with anything that we will need. And you'll still have your local officer, even though we have national asset management that collects that data and writes those reports. So I think that gives kind of the summary of how to get to yes, how to borrow from LISC, how LISC works nationally and locally. I think we wanted to give you all a sense of our funding sources to, you know, clear any questions about are our loans repayable? Is all of our funding from foundations and grants? We actually borrow money and need to repay it. So, you know, we are, although we're a community development finance institution, we really are, you know, a finance institution, and you know, structuring our loans in a way that is creative and flexible, but it serves a need and gets resources into the community, but that won't over-leverage the borrower and won't put the borrower in a position that they can't repay, and the project doesn't become a productive part of the community. So we'll open it up to questions. I think we've had a few folks send in some questions during the slide.
Correct, and we will we'll follow up. I think one question that folks have is if the materials would be available, and we can send out an email with the PowerPoint as well as our checklist and product sheets, just so that people have that information readily available. There were a couple of typos that we'll also fix just to make sure that everything is accurate, and one was around the PREC and board limits, which is above $7 million goes to the board, and then PREC is
$5 million and above.
Yep.
So that was correct.
Yeah, great.
Yeah.
And we'll try to get to as many questions as we can right now, but we'll also write them in a Q&A package that we can send out. So one that someone asked was, can LISC provide debt financing for solar projects?
We have, yeah.
Yeah, we have.
We're looking at a couple of projects right now, and I think historically we've done a couple of them as well. They're a little bit outside our wheelhouse, but we've gotten comfortable with them and the different agreements that are set in place between the various entities that are purchasing the power and where the repayment source is coming from. So yes, we do them from time to time. I will say that they have been with partners we might have worked with before. We're, again, going back to looking at the balance sheet strength of the borrower and the sponsor in those cases. So we do look at some of the other factors that impact the credit as well when we look at the solar project. But yes, we do consider them.
Yep. And the challenge with the solar projects, there are a lot of government systems that are the source of repayment now. But I think early days when we saw some requests, the benefit of the solar panels would go to the tenants in multifamily housing projects, and so it was a challenge to kind of follow the repayment. But there's a number of programs currently in place, or borrowers who have kind of found the source of repayment that makes sense.
Other questions?
So can we speak generally about lending covenants that we have may have around current ratios and leverage or debt coverage for projects?
Right. So it's hard to give a hard and fast rule on that question when it depends on the product and the project. If we are bridging a historic tax credit or committed financing takeout, we might not look as closely at cash flow, just that the project has the funding sources committed. So it depends on if you're asking about, affordable housing, small business, charter schools, and we could get more detail if we understood the exact project and the takeout, the repayment source. But we do have guidelines in each asset category, and we have a pretty thorough underwriting guideline manual that we have available. All of our program officers have access to it. About 250 pages of exciting reading.
Yeah, and I mean, to just add to that, there are certain financial trends that we look at when we risk grade our loans, and those include, as you mentioned, your working capital ratios such as current and quick ratios and days of cash on hand. We look to see how much a borrower is leveraged, so we look at debt to net assets and total liabilities to net assets, and we do have thresholds for those. We also have thresholds for credit scores. And so depending on where those ratios fall within our risk rating matrix, they range from being more risky to less risky. So it's a range, and it's not a fixed threshold unless you're on the very weak side.
So one question was the benefits of using LISC financing versus going directly to a bank.
I think maybe I'll ask Shira to answer that.
Yeah.
Shira, would you like to answer
Sure.
that one? The benefit of going to...
I need to unmute you, Shira, but that was great.
I mean, I think from our perspective, it is really the relationship, and that we really understand and support programs, sort of in the low-income communities, and we understand the interplay between government programs and those financing sources. So from our perspective in national, really led by the local offices and their relationships and their understanding of why the project is important to the community. But I don't know, Shira, if you had anything to add to that?
Yes. Can you hear me now?
Yes.
Okay. The one thing I would like to add is, LISC oftentimes is the first money into a project, meaning we may be providing technical assistance or help with the borrower, putting the project together and coming up with the best strategy for future financing. So I'd say from that standpoint, being an early in lender and providing potential pre-development loan in order to stage the project is another key benefit, in addition to the technical assistance and the local knowledge and local contacts and support.
And we do fill in gaps where banks hit loan-to-value thresholds. If they'll only do an 80% loan-to-value, we'll come in and provide that gap financing. We can go up to 90% loan-to-value. That's typically higher than most banks would like to go. Shira already pointed out early phase financing. And then, Malini went through a couple of projects where there wasn't a nice, neat fit for the loan, but we're creative on, okay, we'll use off-site collateral, or we'll use some funding sources that we've raised because a funder's committed to doing very affordable housing or healthy food. And so we try to pull together resources to address needs in our communities. After we did a lot of affordable housing, there was a demand for better schools, so we started charter schools. As time grew and there became issues around, weight and healthy eating, we sought healthy food financing and got financing to address putting grocery stores in food deserts. So I think we do work with banks, and we are partners with banks, but we try to fill the gaps. We try to be in areas where banks don't typically or go because of thresholds or not having the dedicated resources for a particular need.
Last question, because we have some members of our economic development team in the room. I'm going to ask, do we work with non-real estate related small businesses, and if so, how do we secure those?
Great. Well, good afternoon. My name is Steve. Thank you, Ms. Harris, for that question. Yes, we do work with non-real estate related small businesses, your mom and pop shops, small bodega grocery stores, retailers, consultant companies, or whatever. For the most part, any loan under $350,000, we're going to put a UCC and secure the primary collateral for the loan if it's equipment. And if it's a little bit over $350,000, we may want to secure it with some real estate. But generally, those smaller businesses, we have a number of programs in various cities that we have local credit enhancement, as discussed in the presentation, to help us secure it. And we also have our small business affiliate, immito, who's our SBA lender, and they can do transactions up to $5 million. But at the same time, that's SBA guarantee that would have to be applied to those particular loans. And over $500,000, we're still looking for real estate in best case scenario on those as well. So feel free to reach out directly, and we'll be more than happy to answer your questions if you have any additional questions.
Thank you, everyone, for joining today. For the questions that we did not get to, we'll include them in some of the follow-up items that we send out later this week. Thanks again, and we look forward to working with all of you in the future.